Good evening, ladies and gentlemen. Today is the 15th of March and was an extremely sideways day, more or less, but we saw random spurts of movement, random 30-point up moves which got sold into, random 35-point up moves that got sold into. Generally, it was a down day, and for the day we managed to break even on the trade, more or less. Today, I think there's something interesting to add, something that you won't have seen in some of the previous videos. And this also is a testament to a lot of people who call me a robot and who say I can keep my emotions fully in control. It's not possible for anyone to ever do that. There is a concept of emotional capital. I think as a trader, everyone should be aware of this. I'm just going to go over it in brief. It's basically when you win, it takes up emotional capital. So it costs emotional capital to feel happy. When you lose, it costs even more emotional capital. And at every point, at different points, when we're trading, we feel like we're winning and losing, we're feeling joy and we're feeling sorrow, and that eventually sort of burns you out. And sometimes eventually if you're running low on emotional capital, it might make you an irrational trader. So today I found myself slightly frustrated when certain data was not playing out as one would have expected, and what I did at that point was completely cut my trade and completely risk off to not do anything stupid or irrational at a point like that. The day itself was perfectly fine and should have been easily managed in any situation. But that being the case, since I personally didn't feel like I was in the best state of mind to trade, I tried to risk off, and more or less the intention of the day was to break even. We broke even and after charges slightly in the positive, but I think that should be the biggest takeaway for today's video. I hope you have a good time watching this, and wish you a great evening ahead. Good morning, ladies and gentlemen. So yeah, it was not trading yesterday. As I mentioned on Friday, I was traveling and just got back last evening. So yesterday seems to be very interesting. We had quite a dip and then a big short covering up move. Those who weren't able to get out around 2 o'clock when the short covering began might have found it difficult to navigate. So in general, the idea is that market remains strongly biased towards 15,000 and dips towards 14,800, 14,700 invariably are getting bought, and rises towards 15,150, 15,200 are getting sold into. At the same time, we're having big amount of intraday volatility, which is why it is important to be careful. So what we have done is created a short strangle, 14,700, 15,250, 550 point range with 60 points in it currently. We've hedged at 300, 350 points. The idea is we will continue to remain sideways, but we might have big volatility intraday, which is why we don't want to take a short straddle position at 15,000. So that being the case, in morning we had a small mess up. I tried to purchase the 14,000 put of March, instead purchased 14,000 put of April, and by the time entered and exited that position, we managed to take a little damage on it. That being said, now our hedging and our position is fine, and we will continue to hold. Okay, in the meantime, let's also go over what is the adjustment plan for today. So we're expecting volatility to be there, so we're not going to be too easy with our movements of position, but at the same time, we're going to ensure that we're not capped on risk towards any side. So the idea will be if we start heading towards 15,100, so when we break below when we break above 1550, we will move away half the calls to one strike further, and if we test 15,100, we will move all the calls further away. On the both side, exactly the same logic. If we start testing 14,950 and we hold below 14,950, then we will move away half the puts to a lower strike. And if we start heading towards 14,900, the second we touch 14,900, we will move away the rest of the puts. So that is the idea with respect to how we are going to manage the volatility. It's still quite tight. Another way of working, if you want to be very aggressive, is saying that, okay, worst case, you hold the position overnight with enough conviction. You can adjust at 14,900 and 15,100. This is very simple. And I got a comment recently saying that this is so simple, you're not doing any special strategy. And that's exactly the point. I'm not doing any special strategy, and this is what should be communicated to everybody, that there is no special strategy here. It's as simple a strategy as it gets. You don't need special strategies. You don't need some kind of a brilliant trick to figure out. You don't need to have the best possible view or be right all the time to win. You just need to know that when you win, you try and keep what you won, and when you lose, you don't give up more than what you're willing to. So yeah, it is simple. The problem is in the finance world, everyone tries to tell you everything is complicated. Doesn't necessarily have to be. Simple things work. So that's the idea for today. We'll keep you posted. Same time, taking a look at what's happening. Right now, IT is looking quite strong today after the gap up. Reliance after the gap up is once again testing 2100. I have a Reliance position which does really well around 2200, and that is expired at the month end. So my plan will be not to make any adjustments to it, and in fact just roll forward the position and maybe roll down the puts a little bit in case towards the end of this week it's looking like Reliance is holding around 2100. Then I will roll forward. Just to show you what I mean, what we'll be doing is, this is my Reliance position. Currently, previously we had moved it up because of the up move, and we had booked those puts and we'd move puts in the money. Now in the reversal, these puts are bleeding. So what will be the plan here is to not make any adjustments to this. We are not going to move down our calls or move away our puts. Instead, we're going to square off the puts and the calls and move them to the next month. And by doing that, we will get a much more space on our lower side break even. So that is there. Meanwhile, we're now seeing a dip, which is once again pulling Bank Nifty to the day's low. These puts have started expanding, but we're going to wait for 14,950 to be taken out and held, and then we will move away our puts. Calls are also really crashing, so that's a good thing. And now we will wait. And we'll see how far this dip goes, if this dip gets bought, because currently I'm of the opinion that this will be both a buy on dips and sell on rally market. So we're not seeing some kind of a cascade. Bank Nifty at 35,000, not seeing too much downside from there. Reliance 2100, not seeing too much downside from there. So unless there is downside coming in from anywhere else, we are not too concerned of this dip at the moment. Yeah, not too concerned by this dip at the moment. IV continues to go down, and these options are expiring on Thursday. So such a wide triangle cannot retain too much value. Yeah, so that being the case, even then, so we're not holding below 14,950. If we hold below 14,950 for 10-15 minutes, or we see another 20-30 point move from there, then we will square off our puts and move them away. We have stop losses open on these anyway at 51.52. So in case there's a sudden move, we should be able to get out with that. Okay, just taking a look at some of the OI at this point of time. Right now, we're just holding at 14,950. Is that during the dip, we're actually seeing that the 15,000 put is gaining in open interest. So dips are being used to sell puts, and 14,900 put as well. You can see dips are being used. So Nifty is going down and the OI is actually going up. So there is no expectation of too much downside currently in the market. That is the indication that we are currently, excuse me, that's the indication that we're getting. So we're seeing call unwinding at low levels, 14,800, and seeing good amount of 15,000, 14,900, 14,800 put writing. So that gives us some indication that currently our put trading more expensive than our call is perfectly all right. The thing is here, if we try to roll down our call, try to roll up our put, eventually try and reach 15,000, it won't make a lot of sense. Basically, what will happen is we'll be losing on each adjustment. Instead, in that case, the better idea would be to trade with a opening 15,000 short straddle, which also works. But we don't want to do that. And instead, right now, in this nature of market, our idea is to move away and reduce the risk on our plate at each point of time. And since 14,900 never got tested, now we're heading back up. The puts are losing value and calls are not gaining as much as what they were trading in the morning. So yeah, currently I think for now our view holds good. Bank Nifty as well, 35,000 acting as a good support. Reliance is the only thing that's not making a big bounce from 2100. We're seeing IT take off. We're seeing um, quite a bit. So for now, we continue to hold this. We have about 55 points. We can expect something like 10 to 15 points of decay. If there's absolutely no movement, maybe more than that. So in the FAQ, I covered the margin. In case you haven't seen both the FAQ videos, just take a look at the frequently asked questions, because a lot of people ask the same questions again and again on Telegram or on in the comment section. So I'll just keep answering a lot of them in the FAQs. So whatever questions you have, you put them down and then look for when the next FAQ comes, and I'll cover everything. Right now, in terms of margin, what is the margin being used? Everyone thinks there's some kind of huge margin being used for this. Absolutely not. If you see, currently margin used is 1.14 crores, out of which 10 lakhs is for the positional trades that we have open. The Bajaj Finance and the Nifty position, that takes about 10 lakhs of margin. Our effective margin is about 1 crore. And that's because, so how are we trading 250 lots plus on Nifty with that? That's because of, one is the MIS, and second is the fact that we are hedging it. We're hedging, so we're getting hedging benefit. So yeah, so far very uninteresting day, but yeah, lately we can be uninteresting for the entire day and have 200-point move in the last few minutes. So we're going to have to be quite vigilant about it. Okay, so we continue to see a good up move. Buy should be sideways to positive, and this is basically being contributed by everything. So Reliance a slight pickup, Bank Nifty now heading higher than 35,000. IT is very strong, so it's taking the Nifty up. Right now we are almost 210 points away on the call side. These calls expire tomorrow, the day after tomorrow. So we're quite comfortable with holding on to this, and we don't want to move up our puts either. Our condition remains exactly the same. We break and hold above 1550, we will move up half these calls. In case we then start heading towards 15100, we'll move up all these calls. If you look at the open interest as well, there is good amount of call rating that's taking place at 15300 and 15200, both these strikes. That is, in fact, currently in the OI, that is significant. That is what important. So we'll have to see if we see any of the 15200 start getting to unwound. There's probably some amount of unwinding happening. We'll have to wait for this to update. But yeah, call side, this level should be protected, and there isn't enough strength or momentum in the market to head up there. So that's the hypothesis for now. Obviously, the call price is expanding. This, which had during the dip gone down to as low as 20, is now back up to 34. That being said, the put also has really crashed. Do we take in more put side credit? No, we don't want to take any put side credit until we are above 15100. So till then, the only plan will be to roll up the call side. So call side, we will be rolling from 15250 to 15300. Currently, the 15300 is trading at 25. We will we head above 15150, then this will probably head towards 40, and the 25 will probably head closest towards 30. So that'll be the plan. Not panicking on the call side at all. We are comfortable with it expanding in the way it has. Okay, so back to being balanced, and we've taken additional put side credit. The reason we had to do that is because lately we are seeing that short covering moves can span 100, 150 points just to see the next day that being once again sold into. So this is fair enough. Our put is 250 points away, our call is 200 points away. So this is a good position to be in, and we'll keep you posted. The reason we didn't want to move the call away is the spread is not very good. We're hardly getting some 25, 26 points on the 15300 call, and in case there's a reversal, the puts will really spike, but those calls won't give us too much. So that being the case, we've taken additional put side credit because now we're firmly holding above 15,000. Okay, so for now we're balanced, and Nifty as well, just holding above 15,000. We're just taking a look at what's happening on the OI front during this. During the dip, we saw put writing. So during the dip, we saw put writing. During the rise, we're seeing call unwinding.
the rate of the rise, of course, meant big short covering happened, so a lot of unwinding. And now we are once again stable. And we're seeing that obviously for this expiry, 15,000 plus minus is what it was looking like from the overall open interest. But if you see the rate aggression with which um, calls are being unbound, and you're seeing that 15,000 calls also, you'd expect quite a few to be written. This should also be a sell on rise market along with buy on dip. The bias is definitely to the upside. So 15,200 and 15,300 is what will be the actual upper ceilings of this expiry, is what it's looking like right now. So it might be another, I think it's the fourth consecutive expiry where 15,000 to 15,200 has been some kind of a ceiling. Right now, obviously on the downside, 15,000 is not a ceiling, but it's building towards that. But 15,200 on the call side, potentially. The ceiling thing is there isn't any trigger right now to break that sort of a range. So every expiry, we're coming back to the same range. And considering the monthly positions built up on the Nifty, should all be centered around 15,000. So the rest of the month, 15,000 plus minus seems very, very attractive. We've been seeing this straddle since it was worth around 800 plus points. And yeah, continues to be the case. Our plan now is that if we start testing 15,000 again, then we're going to move back down on the put side, because the calls have deflated, the puts have not really gone up from when we shifted to this position. Test of 15,000 and below, we'll just move away on the put side. Okay, we're testing 15,000, so we've moved down half of our calls. Half of our puts. We moved them down by 50 points. We'll wait for 15,000 to be properly breached, because we're seeing everything, whole market is moving at once and everything dipping at the same time. And yeah, we want that kind of volatility. Of course, the position remains to have positive view, but we have risked off 50% on the put side. We moved it down by 50 points. And yeah, the idea now will be to wait and see. If we continue to see a slide below 15,000, we will move away the rest of the puts. We did half of it preemptively, and the other half will be after actually heading below 15,000. Okay, so now, I mean, obviously, nothing really that can be done. The whole market is moving in a single trend today, so which is even more reason why we would do risk off if we start seeing everything dipping. We've now squared off all of the 14,800 puts and moved them down to 14,750, and we are at the 14,750, 15,250, 250 point in either direction strangle. And we will now wait and see if we continue to slide, and as we test 14,950, we will then further move further away with our puts, because we don't want to take excess downside risk also by moving down our calls. We don't want to move down our calls. 15,200 is probably a good spot. So if we hold below 15,000 for a while, we will consider moving this down to 15,200. But beyond that, no further downward movement of the calls. We will just be moving away with the puts. We'll see. I mean, right now there's no momentum in the market. I don't know, many people who feel that I only sell options should look at my first 3 videos. The first 3 videos was all options buying. There is time to buy options, and that's when there is momentum. So you buy when there's absolute ridiculous movement and you're unable to manage a triangle. That's when you buy options instead of selling them. So that being the case, yeah, this is not the kind of market to buy options unless there's quick momentum and you're able to get in and out of the buy trade very quickly. So for now, this continues to look good. Now, considering we'll wait for another 2 candles to keep us below 15,000, and then currently, how much are we getting for the 15,200 call? Getting about 32, which will be a good enough balance. One more thing that's really not the best case is 15,000 is such a big psychological level always. So the fact that we're moving above 15,000, when we go above 15,000, suddenly everyone's like, yeah, now we're going up. And the moment we go below 15,000, suddenly the fear spikes up on the downside. It wouldn't be the same if it was 15,100, 15,200, or any figure which is not 15,000. Because it's 15,000, it's always a big psychological thing. So each time you will see swings in options pricing, which will vary their prices immensely because we're moving around the 15,000 mark. The rate at which people will switch sides will also be much higher. Okay, 12 o'clock, and we saw this massive candle, really sudden up move, like of 50 points, and it happened almost instantaneously, crashed the puts, really expanded the calls. You see, just chart this out and see how much this moved. In a minute, it crashed from 38 to 26 and then continue to head lower. But what we did is risk off the call side, move the calls back up. And yeah, that was tricky. That was an addition of 10 points on the call, just like that. So interesting. But anyway, we have used that as an opportunity to get out of the calls and move them higher. We're not doing anything with the puts. And this will continue to be our position for the day. No more changes from here. The randomness that's happening is going to catch us off guard until we see a test of we head above 1550 and start heading towards 15100. We're not going to make any further changes. We're just going to hold on to this position. 50-point candle. So yeah, in 2 minutes basically, we did 60 points in 2 minutes. So anyhow, this is expected, and yeah, as a step against having to deal with that stuff again, we're just not going to adjust unless we see a clear move away in that 100-point range, plus minus 15,000. So we see a clear move, then we'll make any changes. If not, we'll just hold on to as it is. Okay, the time is 1 o'clock and we're sitting on a little more than 5 points. It's been a very interesting day, only 100-point range. And the thing is, right now we have gotten used to seeing more than 150 points at least on an intraday basis, and sometimes 200, 250, but very tight range. And that being the case, each time we've had to adjust for our risk in any particular direction, and then we've seen that it's just reversed back. Obviously, the best trade would have been the 15,000 strangle. I'm sure the 15,000 strangle since open would have gone down at least by 20-25 points. That being said, we only have to use the volatility that has happened in the past few days to set context for what is possible. And you should never look back at a decision like rolling away the calls or rolling away the puts and then getting reversed on in a negative light, because hindsight is 2020. But in this form of trading, you can't afford to take too much directional risk. Getting your view right is great, but being right with your view isn't exactly what you're going for. You're trying, what is the primary intention of the trade? To not lose money. So if you're not losing money, you're already winning. And each time, if you're like giving up some reward by taking less risk because you feel like your trade is imbalanced and that it might potentially cascade, it's a good thing. So it complicates a little bit that we've had historically past 2 weeks, just a random volatility. But that being said, we should never be apologetic about the fact that you could potentially have captured more points and that you didn't. So I think overall, that kind of mindset to create for anyone is difficult, for me as well. Like, I roll up my calls and suddenly, okay, bam, red candle completely takes out the 50-point moves. Everyone, it does poke everyone. There's nobody who can be like, yeah, it didn't annoy me that happened. But at the same time, you need to know that the bigger intention, more than making money, is to not lose money. The same call that expanded from 30 to 40 could have expanded from 40 to 60 in a matter of two more green candles if that really triggered a big short covering move, right? So that being the case, the time is 1 o'clock. We've still got 2.5 hours to go. We should be, if we continue to do what we're doing now, we should be able to capture another 5 to 10 points at least. Today being Tuesday, also, you don't see too much decay happening on a Tuesday. But if absolutely nothing happens in the market, we should be good to capture another 5 to 10 points. Okay, so quite confused overall. Bank Nifty gave up very quickly, about 300 points and yeah, that really started expanding. These puts we got out, we moved them away, and the calls also are not particularly decaying to compensate for the fact that puts really expanding. This is what happens when you maintain a range for the entire day and suddenly you see a move. Prices will really inflate as well. So we move down our puts for now, and we will consider moving down again if we test 14,900. The second we test 14,900, we will be getting out of these puts and moving them further down. Okay, so what's happening now, and we'll also set up an exit for our trade if this continues, is we're seeing a dip mainly coming from Bank Nifty, nothing else, which has pulled the Nifty down. And yesterday's close is somewhere around here, so 14,900. And that has led to a huge expansion in the put side fear, which is why this put, which is still 200 points away, is trading at 36, the 14,700. And this call isn't particularly decaying to compensate for that as well. So if we hold above 14,900 and don't really see a breakdown, this put should give up a lot of its value. We have stop losses on this just about 10 points away, but 200 point away put expanding by 25% will be quite a bit. So that is after considering the fact that this has already expanded because of the increase in put side IV. So if that stop loss hits, then we're going to exit the trade completely. We're not going to be trading further. So essentially, if this gains by 10 points, this should have lost at least 5 points. 5 points is what our stop loss now for the day will be. And yeah, it didn't help that we spent so much time sideways that the options premiums themselves were really low. But anyway, that's more or less the plan for the day. After that, if there is any opportunity to go long in options, if we see that kind of a breakdown, we'll consider. Okay, the time is 2 o'clock, and we've basically seen a pullback from 14,900, and once again that's getting sold into. So what's happening on the OA front is we're seeing good amount of call writing now, and some of the puts that were written earlier starting to get unwound at 15,000 and 14,900. We have a sacrosanct exit clause now, which is if we again hit to today's low, we're going to cut out of the trade completely. The reason for this is a lot of people would have gone long after yesterday, after we broke yesterday's high. Many people would have gone long because of the short covering. Many people at the day's close would have gone long. Today, when we gapped down and then made a high, a lot of them would have set a stop loss at the day's low. And as we started heading there, we saw this breakdown, the stop losses hit. And once again, people went long at 14,900. Which is why if we now retest 14,900, everyone who didn't get out earlier, and again these people who went long, all of them will start unwinding at once, which can see a big cascade on the downside, and we don't want to participate in that at all. So, and at the same time, what's happening is the fear on the upside is not particularly coming down. The calls should have decayed more than what they have, because everyone is keeping in mind the potential short covering that can come with all the shorts that have been built up. So it's neither here nor there. It's not the best case to be trading strangle. So that's why now if we lose another 30 points from here and we test 14,900, we're going to start exiting. Okay, time is 2:20. We've basically cut out of our entire position except the hedges and then re-entered, but in a slightly different way. The idea now is to keep this 650 point range, because we're getting sort of played by the market today, and that's making me a little impatient. And the best thing to do when you're feeling a little impatient is exit all the trades. Exit all the trades is the best thing to do. What I've done instead is I've just taken on much lower risk spread where the premiums are still pretty decent, at least at the point when I entered it. What did we enter it for? Yeah, so we entered it for about 18.5 on the call side and 18.75 on the put side. So yeah, that's the exact point at which we entered, and we've set up stop losses. We set up stop losses of 27. We're not going to do anything to this trade. We're just going to hold this trade, and we're not going to look at any of the big moves that are happening or what adjustments to be made, because if you see how we're moving today, so this is the 1 minute time frame. I've opened the 1 minute time frame just to show you that we're having random 65 point moves and especially here once again 30-point move in a matter of a second. This wasn't a 1 minute move, this was a 1 second move. So you're seeing this big green candles and then they get sold into and whatnot. So we're not able to manage our position effectively because we're seeing in seconds we're adding 30, 40, 50, 60, 65 points also in this case. And then that's getting sold into and it's doing all kinds of things with the options. So risk off is the best case scenario. We've sold this. When we sold this triangle, this was worth about 36, and we've set a stop loss at 27, which is perfectly all right. We're good to hold that position, and we're just going to hold it for the rest of the day, not making any changes from here. And this is just taking into account that some of the deeper OTM options are still trading at good prices. The action itself remains between 14,900 and 15,000, but when you're not in the best state of mind to be handling the position, the best situation is to get out of the trade or do something like this where you've just set up a trade and it has an exit criteria, and that is that. What we can also do is if our mark to market starts improving, and currently we're down only about 1.5 points, but it's not about being down 1.5 points or not. Regardless of not being down much, if you're just not in the right state of mind, you shouldn't be taking the trade. And for whatever reason, I'm feeling a little impatient, and that's why I don't want to continue to hold the trade. So we'll keep you posted. The time is 2:23. Okay, so the time is 3:07, and we're seeing a retest of the day's low where we dip below 14,900 again. The idea will be if the put side really expand, then we will create a bull put spread or a broken wing butterfly favoring the upside towards the close. That will be the idea. If the puts continue to remain very expensive, then we'll do that, because the idea is we will get bought back towards 15,000. Might not happen today, but we might have a gap up situation tomorrow. Currently, the idea would be to be biased to the upside for sure. And in the meantime, we'll keep you posted. We have stop loss market orders open on the puts at 25. So in case the puts do expand, we will be getting out of them. But to carry or not to carry, that is a call that we'll have to take soon. Okay, so last moment, we're not seeing too many moves. Considering buying the dip on Bank Nifty, but since I already have long exposure and a lot of financials, not really favoring it too much. Currently, we are more or less at break even, but after charges probably half a point down from where we are currently. And the idea will be to get the last 7 minutes of DK as well before we auto square off. So that's the plan for now. We'll keep you posted. Okay, we've updated our stop losses to 18.5, which is just 1 point away from the call side, 1.5 points away, and 2.5 points away from the put side. So we're more or less looking at a break-even day. Actually, considering the day it was, we could have done much better, but we completely risked off the moment we started to feel impatient. And that's the best call in such a situation. So we will more or less at this point looks like be breaking even for the day, and hopefully we cover the charges as well. So that being said, I think if any takeaway is there for today, it should be that whenever you feel like you're not in the best state of mind to be managing a trade, don't be managing a trade, risk off completely. I think had I tried to manage my existing position for the remainder, retrospect hindsight 2020, today would have been all right. In a different day, not so much. So also, when you don't have a trending move in the last few minutes, this is what happens. Option prices completely crash. Everyone who went long during the day will start exiting it. People who don't want to hold overnight, everyone starts exiting. They really crash big time. So we'll more or less start manually exiting this trade ourselves. We'll have to. I was considering a bull call spread on Bank Nifty, but decided against it. I already have enough long exposure on my positional trades, so no need to add to it. Okay, so Zerodha is now auto squaring us off, and yeah, we can expect slippage to happen. And yeah, more or less, we bought back the spread for a decent price. And net for the day, I think after charges will be slightly in the positive, which is fine. Was not The entire idea was to get out of the trade with as little damage as possible and risk off. And we managed to risk off and also cover our charges at the end of the day, and that is a good enough outcome. Each day is a new day, and if you're not feeling it on any particular day, that shouldn't be the day that you try and create a high risk spread. So, that being said, thank you so much for watching, and I'll catch you tomorrow. I'll be trading tomorrow as well. Have a great evening. Take care.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab. So do not forget to check that from time to time.